so in love with you.
You guys, welcome back to Real Estate Mindset. So today's video is going to be about some bonkers data, and I want to explain to you how the interest rates work as it pertains to the Federal Reserve raising the discount rate, how that impacts mortgage rates. So today's video is surging interest rates destroy affordability, leading to a 2022 housing market crash. And when I say crash, guys, what I'm talking about is negative equity. Now, I don't think every city is going to be hit with a crash, but I do think some cities are going to be hit with a crash, especially metro areas that were in high demand in 2020 and 2021. So what we're going to go over today is we're going to go over the data. Now, after we go over the data, I'm going to share with you at the end my opinion. But what I really need you guys to understand is a couple things. The first thing is, remember this. For every 1% interest rate increase, it removes purchasing power of about 10%. So 1% of the rate going up removes about 10% of the purchasing power. Here's another thing that I really think is important for you guys to understand. Now, just because the Federal Reserve is only raising their interest rates 25 basis points or 0.25%, that does not mean that mortgage rates will only go up 0.25%. It's very important for you guys to know that. So we're going to look at some data right now, and I'm going to show you guys that regardless of the 0.25 point or 25 basis points that the Federal Reserve increased the rates yesterday, the 16th, that's not going to translate into a 25 basis point increase in mortgage rates. So we're going to be experiencing interest rates much higher, much more quickly than you would think. Now, before I continue, you guys, please like this video, subscribe to my channel if you haven't already, and as always, please comment on the video and share it. Share this video, okay? Now, what I'm going to do is I'm going to bring up a graph right now from Freddie Mac, and this graph measures the average, the U.S. average 30-year fixed rate mortgage. So let's take a look at that right now. Okay, you guys, so you can see here that here's the Freddie Mac 30-year fixed rate average mortgage rates in the United States. It was just updated today. And as you can see, as I've been saying, the rate average as of Thursday, March 17th, which is today, is 4.16%. We are already in the 4%, okay? So let's take a look and analyze this data. Now, the first thing I want to do is just show you guys, as of March 10th, the average rates were 3.85. That is 1 week prior, about a week prior to the mortgage interest rate increase. So even though the Fed, even though the Fed raised the rate 25 basis points, the average rate actually went up 31 basis points. Okay, so you guys, so just taking 1 week difference, the Feds raised the rates 25 basis points, the federal discount rate, but the mortgage interest rate average went up 31 basis points. So remember that even if the Feds are only doing 0.25 point, 0.5 point increases, that is going to be a big difference in the mortgage interest rates, because remember, mortgage interest rates are very sensitive. The slightest fluctuation in certain economic or political factors and the Fed's tightening quantitative easing and things is a huge impact to mortgage interest rates. But let's take a look at the data some more right now. Now, I want to start at the beginning of this year, which was January 6th. So as you can see here, January 6th, the average 30-year fixed rate was 3.22%. Now, remember, at this point, there was no Federal Reserve increase in interest rates. Okay, so it was at 3.22 in January 6th, and then the Federal Reserve raised the interest rates 0.25 point. So from January 6th to today is 3.22 to 4.16. Okay, so that is a huge difference. What that is 94 basis points difference from January 6th to right now. So remember what I'm saying. As of January 6th to now, there was only one interest rate increase of 25 basis points, but it translated into almost a full % of mortgage interest rate hikes. So I really want you guys to pay attention to that, because I'm thinking before the year is out, we're going to be seeing 6%. And at the end of spring, I think we're going to start seeing 5%. So let's look at this even more. Let's compare August of last year to right now and see how much the interest rates have gone up. Let's pull that up right now. As you can see, August 5th, the average interest rate was at 2.77. So August 5th to right now, 4.16. Okay, that's a difference of 1.39 or 139 basis points. So 139 basis point increase from August of last year, which essentially translates into a 14% reduction in purchasing power. So even though the Federal Reserve raised 25 basis points, it translated into a 14% decrease in purchasing power. And the reason I'm really emphasizing this, you guys, is because I've had a lot of people still comment how it's impossible for a housing market crash. It's not going to crash. There's too much demand. There's not enough supplies. And I agree with you. There is not enough supplies. There is not enough demand. But remember this, instantaneously, things can change. And the biggest combat to high demand is removing the affordability. And that is what we're going to start seeing from here on out. Because remember this, the Federal Reserve yesterday said they anticipate 6 more rate increases throughout this year. Now, if there's 6 more rate increases throughout this year, imagine what that's going to do to the mortgage market. Do you understand why I'm saying 5%, 6%, and how affordability is the biggest risk to the housing market crash? It's not even domestic demand. It's the fact that on top of the inflation, on top of all of these things, people, quite frankly, cannot get qualified for home loans anymore. Now, remember, I've said this, that one of the major differences in the 2008 and 2022 housing market is the quality of home buyers. It's basically the standards of lending, okay? That's a double-edged sword. Because the standards of lending are so strict in 2022, that means it's going to be a lot easier for buyers to no longer qualify. Think about that. Yes, it's a lot more tight. They're a lot stronger buyers. And that's specifically because of debt to income ratio and income qualification proof. You have to prove through several different ways you make a certain amount of money and you will continue to make a certain amount of money. So now that not only the prices of homes have soared, interest rates are going to start soaring, and that is going to cause a lot of people that are qualified right now in the housing market to be removed from the housing market, okay? So let me share with you guys now my overall opinion. So like I said, I believe that this year we're going to see our first set of negative equity or a housing market crash. I believe the fourth quarter of this year is when we're going to start really having good buyers incentives. I believe at the end of spring, we're going to start seeing 5% interest rates as the new normal. I believe going into fall, maybe the end of fall, we're going to start seeing 6% interest rates. Again, I'm not a financial advisor. These are my opinions, but here's some of the reasons why I think not only the interest rate is going to cause a housing market crash, but let's take a look at all of the factors. Number one, inflation, okay? And I'm talking just normal inflation as it pertains to everyday living. Gas and food is through the roof. Home prices soaring through the roof. Interest rates soaring through the roof, which is all deteriorating affordability. Now let's keep going. It's also cheaper to rent right now in a lot of cities than it is to own. And if it's cheaper to rent, probably a lot more people are going to start renting. On top of that, consumer confidence right now is at an all-time low because buyers have been getting beat up with multiple offers. They've been losing bids. That takes a lot of effort and that takes a lot of emotion. Also, as we've seen, investor demand is drying up. And as you guys know, in certain metro areas, up to 50% of the homes were purchased by investors. BlackRock got hit, $17 billion loss this week. Zillow got hit. They're out of the market. Redfin, out of the market. We're going to start seeing a lot less investor demand. Also, we're not going to see double-digit equity growth. Homes are not going to go up as high in value this year. Also, the mass migration is slowing down. We're not going to have as much people going into Sunbelt cities and high demand metro areas, inflating the prices, but also fear. There is so much fear right now in the market of a housing collapse that people, quite frankly, are stepping out and they're renting. And you guys, all of those factors that I just listed is why I am confident that this year we're going to start seeing that negative equity growth and a collapse in our housing market. So quite frankly, the housing market is only standing on one leg right now that I can see. That one leg is supplies. If we had a plethora of supplies right now, I believe we would already be in a housing market crash. I believe we would already start seeing negative equity growth because of all of those things I just listed. With the one leg right now that is undisputable, I can't dispute it. No one can dispute it. The supply is so low that it is messing up. That is the only thing that's standing on, okay? Demand is red hot still because the FUMO is still out there. The market is still ran and being taken over by FUMO because people are afraid of missing out on opportunity, right? And that's what we're seeing right now. But as we go on in this year, you guys are going to start seeing a surge in people leaving the market, a surge in interest rate. And what I hope is by the end of the year, we're going to start seeing a surge in inventory and active listings. That is why from the bottom of my heart, I'm telling you guys to be patient, sit out. Now, what my opinion is, everyone needs to save as much money as possible. You need to get out of consumer debt and prepare yourself to be a solid buyer going into 2023 and at the end of 2022. We can all do that by rearranging our budget, by monitoring our budget, download apps like mint.com. And also what I want you all to do is enjoy your family, because right now, really all we could do is sit out, okay? That's my advice. As always, you guys, please continue to comment in the comment section below. Now, as you guys know, I'm a realtor in Houston and I'm a loan officer in the state of Texas. So if you need any information, if you want to talk a little bit more intimately, if you want my opinions a little bit more specifically, just email me. My contact information is in the description. Now, as always, guys, I hope you do well out there. Good luck, and I hope you win.